everyone, and we're live with Option Edge. I'm Eric, and today we are looking at Caterpillar, okay? Caterpillar, we saw some major selling. We've seen some major selling in the last couple days, last week or so. In Caterpillar, we're up around 245, and now we're down almost to $200. We're at 209, okay? So one of the reasons I'm in a trading group, and one of the people in the trading group pointed out how low the RSI is. And if you look, RSI got like to 20 today, okay? And if we look historically, let's zoom out. You can see the last time that happened, we had a nice little rebound. Took a little bit of time to come around. It also hit here, and then here you can see this ended up being a loss. That ended up being a big loss. So we're going to have some patience with this one. Keep going. You see here it really went down. That was October 18th. But you can see that one was a successful win. But so with my back tester, back tested this strategy when, here's the trigger, when the RSI is below 25, today was, we're going to open up a diagonal trade. So I've showed you this trade with, that's not the right trade. I've showed you this trade with Elastic. I showed you with Okta for the 3 inside up trigger. But basically, for some reason, it's not allowing me to click this box here. But basically, we're going to buy the 50 delta strike. That's 60 plus days away. So August 20th, it's about 64 days away. And we're going to sell the 20 delta call that's dated 30 days till expiration. Okay, let's try one more time here. Why is this not letting me? Anyway, that's not working. I have it drawn up here. You can see. So we're going to buy the open, the 210 call. That costs $9.70. And then we're going to sell to open the July 16th call at the 220 strike. That is going to be, we're going to get a credit for $2.70 for a net debit of $7. Okay. So let's go back, and here's what the strategy looks like. We're up $3.03. Boom, boom. That's what we chose. And if you're confused on how to open this up, we just simply go to the options chain. You select, boom, hit the plus sign for, that's buy. We want to sell the call. Now we're going to go to August 20th, flip this to buy, and now we're going to buy the call. Boom. That's the trade. So that's Robinhood covered. Next trade, that's my channel. So, and then let's check it out here in E-Trade Options Visualizer. So we're currently trading at 209 about. So let's say if the stock doesn't even move in 3 weeks, the stock doesn't even move. You can see the blue line is the July 9th. That's how much money the option will be worth on July 9th. So even if it doesn't move, we're barely making money. And you can see even if the stock doesn't move at all, we'll lose $8. But here's the highest we can make. If it reaches that 220 upper strike, we can make $650 upon expiry. So that's pretty nice. So that's that. Currently, the IV is pretty low. If we see a increase in implied volatility, that could help us out. Let's just look at Caterpillar IV rank. 6th percentile, that's pretty low. Implied volatility rank is 6th percentile. Let's see here. This is giving us a fast bearish crossover, which isn't good. So this is, like I said, this is a little risky because it's like we're catching a knife, a falling knife. And sometimes if you catch it incorrectly, you can get cut bad. So the game plan is this. We're going to give this a couple days. I'm thinking 5 trading days to turn around. So by next Friday, if this isn't back above 209, then we're closest trade out. One of my fears is if we break below this, I think we're going to head down to the 200-day moving average. But I'm hopefully thinking if it breaks lower, it'll do sort of a false breakout and we'll come back up. So that's what I'm thinking. I hope this helps. So keep trading. This isn't financial advice, but I'm just trying to teach options and just some strategy. One of the things I like about this diagonal strategy is because if I was just to buy the 210, if I was just to buy the 210 calls by themselves for $9.70, the problem is the first half. This is what happens. I can sell a call that is has half the expiry, half the time as this call, which is what I'm doing here. This is 30 days, technically 29 days. This is 64 days. So basically, what's going to happen is in those first 30 days, what I want is we want this contract to expire worthless. In a perfect world, it will expire. The stock would hit 220 and not budge. We would gain this $2.70, and we would gain whatever the increase in value of that is. But basically, the beauty of it is we're getting theta decay in the shorter option, while the longer dated option, the first 30 days, so it's a 60-day option, the first 30 days doesn't see as much theta decay as the last 30 days, okay? It's exponential. It is, if I could draw that, think of it like an arc, okay? Where the first 30 days of theta decay, if you follow my cursor, it's like this, it's going, and then the last half, it is exponential. Okay, so you're flat for the first week, 2-3 weeks, and then you start to drop off. Okay, it's an exponential theta decay as you cross over that halfway mark in the options. In the when the 30-day mark, it's about the halfway mark, and that's when the theta decay begins to accelerate. Because when you're a call buyer, theta and time is against you. Okay. So basically what we're doing is this strategy takes theta decay and uses it to our favor by selling a shorter dated option that we want to expire worthless. So that's the idea behind the diagonal. And also if we get any spike in IV, that's going to increase the value here, while this is the shorter dated option, and hopefully that expires worthless. So that's it, guys. Sorry for the long-winded explanation. Hit me up if you have any questions. Alrighty, peace.